If you look across the broad spectrum of commercial real estate, most of commercial real estate, notwithstanding low-quality B and C office buildings, are starting from a great place. What I mean by that is occupancies actually are about 95% or more on average across all categories of commercial real estate, except one small subsegment, and that's getting all the press right now.
Top-ranked Barron Real Estate Fund Manager Jeffrey Kolich is actively investing in some segments of the beleaguered sector. He'll explain why and where on Consuelo Mack Wealth Track.
Funding provided by Clearbridge Investments, First Eagle Investments, Royce Investment Partners, Baird, Bill Miller, Research Affiliates, Strategas Asset Management, Women Investing in Security and Education, and Matthews Asia.
Hello and welcome to this edition of Wealth Track. I'm Consuelo Mack. Is this any time to invest in commercial real estate? Well, if you read the headlines, commercial real estate is approaching a crisis. Office vacancy rates are at record levels. Expensive pre-pandemic leases are starting to expire. With more remote workers, businesses are negotiating for smaller spaces. Office delinquency rates on securitized mortgages have soared, and financial conditions have tightened dramatically. These negatives have been recognized in the stock market. Of the 11 industry sectors in the S&P 500, real estate was the only one that lost money, down a little over 1% in an otherwise stellar first quarter when the S&P 500 advanced 10%, its best new year beginning since 2019. Back to my original question, is this any time to invest in real estate? Well, this week we are starting a two-part series on real estate, the first on the outlook for commercial real estate and the second on residential real estate. And our guest is a newcomer to Wealth Track who invests in both, and shame on us for not inviting him sooner because he has a terrific track record. He is Jeffrey Kolich, portfolio manager of the Barron Real Estate Fund, which he launched in 2009 in the midst of the financial crisis. The nearly $2 billion fund is rated 5-star by Morningstar and is ranked in the top 1 percentile in its category for the last 1, 5, and 10-year periods, as well as since its 2009 inception, delivering nearly 14% annualized returns, far outpacing its category and benchmark. I asked Kolich why, given all of the negatives surrounding commercial real estate, he believes the likelihood of a crisis is low.
Ever since Silicon Valley Bank failure in March of 2023, there have been consistent calls for a commercial real estate crisis. And in our view, the calls for a crisis are an exaggeration, a hyperbole, and unlikely to materialize. And the reason that we have formed that view is if you step back and think about the conditions that would cause a crisis, they're largely not in place. And so what are those? Well, number one, it would be if commercial real estate fundamentals, the demand outlook, were deteriorating, meaning occupancies, rents, and cash flows. And across most categories of commercial real estate, business is pretty good. Number two, the historical curse of real estate is when real estate becomes overbuilt after taking on lots of leverage. The silver lining that's not talked about much at all is that prior to what happened in the 80s, where there was a commercial real estate crisis, or leading up to the global financial crisis and housing crisis, this time around, balance sheets are in much better shape and real estate has not been overbuilt to the same degree as it was during other real estate cycles. Because of higher land costs, material costs, labor costs, there's been very little new construction the last 3 years and very little coming in 24, 25, and 26. So what we actually have for commercial real estate is, for most categories of commercial real estate, demand conditions are okay. There still is credit available. Real estate has largely repriced for the higher cost of capital. And real estate at this stage is positioned to perform well if, in fact, the Fed ultimately decreases interest rates and credit spreads come in. So what's happened is real estate's been painted with a broad brush stroke where the challenges of low quality B and C office buildings have been extrapolated to all of commercial real estate, and that's not representative of what's happening.
what the critics are saying. They're saying, hey, there are high vacancy rates and you're going to have to renegotiate leases at much less favorable rates for the building owners. So those are not issues that you're concerned about? Are those not real or just have been exaggerated?
Consuelo, what you're describing is a condition for low-quality, old B and C office buildings. That is not representative of all of commercial real estate. Commercial real estate consists of several different subcategories, including retail malls, retail shopping centers, industrial warehouses, apartments, self-storage facilities, hotels, senior housing facilities. If you look across the broad spectrum of commercial real estate, most of commercial real estate, notwithstanding low-quality B and C office buildings, are starting from a great place. What I mean by that is occupancies actually are about 95% or more on average across all categories of commercial real estate, except one small subsegment, and that's getting all the press right now. And so again, high occupancy, very little new construction activity, balance sheets in good shape. This discussion of a commercial real estate crisis is very much an exaggeration in our view.
That's so interesting because I know that the Barron Real Estate Fund is an outlier in that you are a very well-diversified fund. What are the REITs as a percentage of the Barron Real Estate Fund?
It's about 25% of the Barron Real Estate Fund. Typically, it's anywhere from 25 to 30% of the fund, which is atypical relative to most other real estate strategies. The Barron Real Estate strategy is a real estate-related fund, not a REIT-only fund. 95% of our peers isolate their real estate investments only to REITs, which are traditionally bricks and mortar, office buildings, shopping centers, malls, apartments, warehouses, self-storage. But at Barron, we've always advocated a broader, a less constrained, a more flexible approach to investing in real estate. We invest in REITs, C Corps operating companies, commercial real estate, residential real estate. We've always advocated for the benefits of evaluating real estate through a wider lens than many of our peers. And so what we do is we limit our REIT investments to no more than 25% or so of the portfolio. The other 75% tends to be in non-REIT real estate related companies.
In the REIT segment specifically that you have invested in, what do the fundamentals look like there, and what are the opportunities you see in that particular slice of the real estate market?
We're optimistic about the prospects for REITs looking out over the next few years. REITs have lagged really since 2019-20, ever since the beginning of the pandemic, and this narrative about a commercial real estate crisis and the sharp increase in interest rates, which has been a bit of a headwind for REITs. We think REITs have largely repriced. Business fundamentals are solid right now. Again, very little new competitive supply coming on. Balance sheets are in good shape. And if you look historically, when you reach the end of a Fed tightening period, historically that's an attractive time for REITs. And so we think the setup over the next couple of years for REITs is attractive. There's a lot that we like within REITs. So we're emphasizing what we would categorize as secular REITs. And when we use the word secular, we're referring to businesses where the cash flows are less sensitive to the economic cycle, meaning they tend to be a bit more durable. We're long-term optimistic about the prospects for industrial REITs such as Prologis or Rexford or East Group or Torino, among others. Why is that? Because occupancies are 95%. The rents in the portfolio on average are about 50%, 50, below market rents. So when the rents expire, the leases expire, there's an opportunity to increase rents 50% over the next 5 or 6 years. You tell me another company that has visibility today into 50% growth. So industrial is attractive. We're also leaning into the intersection of technology and real estate through wonderful data center companies, which are benefiting from cloud growth, AI growth, companies outsourcing their data center needs, companies such as Equinix and Digital Realty Trust, wireless tower REITs such as American Tower, which are benefiting from the upgrade from 4G to 5G, and housing-related REITs such as Welltower, which is benefiting from a recovery from the pandemic, but also the secular phenomenon of the senior portion of the population being the fastest growing portion of the population. There's much more in REITs.
Oh, there is.
But the bottom line is we're quite optimistic about the prospects.
You just mentioned the industrial REITs, but are there sections that you would absolutely emphasize, and that you've got a high conviction that the fundamentals, the prospects are really very positive?
Looking out over the next 2 to 3 years, we think the prospects for industrial REITs, given the e-commerce tailwinds, the onshore tailwinds, companies planning for just-in-case inventory needs, et cetera, deglobalization, will benefit these companies. That's the secular side. And then in short lease duration REITs, REITs which reprice on a more regular basis and can generate growth to offset any lingering inflation impacts. That would include multifamily REITs, single-family REITs, single-family rental REITs, manufactured home REITs, and again, the healthcare side. So it's a broad swath, and if you notice, most of that covered REITs. There's only one small segment which is getting all the press, which is low-quality office buildings,
right,
which isn't representative of the opportunity in commercial real estate.
Give us some of the other opportunities in commercial real estate that you're investing in.
After conducting our research, we step back and always try to see the forest through the trees and think about investment themes that may be emerging and could persist across real estate for several years. And there are several investment themes that we continue to lean into. One is REITs, which we discussed.
Right.
We're also long-term bullish on the prospects for travel-related real estate. Think C-Corp companies such as Hilton Hotels or Hyatt Hotels, or real estate casino companies such as Wynn Resorts or MGM or Las Vegas Sands. Why are we optimistic about travel-related real estate? Is that the consumer is diverting more and more discretionary dollars away from purchases of goods, more towards experiences such as travel. Then you layer on that household formation now is being delayed much more so than when my parents grew up, which means that the millennial generation is building up more disposable income before households are formed, and they're spending it on travel. The work from home dynamic, where people have more flexibility, also allows people to travel. Travel is a very exciting long-term opportunity, and we believe these companies are discounted in the public market. That would be one investment theme. Another would be commercial real estate service companies. I'm referring to the leading commercial real estate service firm in the world, CBRE Group, the number 2 company, Jones Lang LaSalle, now called JLL. And the opportunity in this area is people hear commercial real estate service firms and once again think, oh my, these companies have a big problem. The reality, however, is that more and more companies are outsourcing their commercial real estate service needs, allocating more to commercial real estate, and it's an oligopolistic industry where CBRE Group and JLL effectively dominate the industry, meaning that they are number 1 or number 2 in every business line, number 1 or number 2 in every geographic market, and there is a very significant opportunity to consolidate the industry over a long period of time. That's investment theme number 2.
And
number
what
3,
do they actually do?
They are hired to buy and sell buildings. They are hired to serve as a broker for the rental of buildings. They're also involved, however, in property management, in appraisal work of buildings, in mortgage financing, in real estate development, in the outsourcing of real estate, as many companies are turning to CBRE Group and JLL and saying, you take over our real estate operations for us, you manage our buildings. Another investment theme are the real estate alternative asset managers. I'm referring to Blackstone, which is the largest commercial real estate owner and landlord in the world, and they certainly have been in the newspaper for a long period of time, but over the last few weeks, they just announced a major $10 billion acquisition of an apartment portfolio very recently. But what's happening with leading commercial real estate alternative asset managers, such as Blackstone, such as Brookfield, among others, is more and more dollars are being allocated to alternative asset managers because of the strong long-term returns and the lack of volatility in the returns. And so if you have scale benefits with an investment track record, this is another niche area in commercial real estate for our investment theme focus that we think can perform quite well over time.
How does Blackstone compare to Brookfield? How would you compare the two?
We've owned both for a long period of time. We would put both in the bucket of truly world-class, best-in-class companies. They both own exceptional real estate portfolios. I would say that Brookfield tends to have a bit more of a deep value orientation and a willingness to move into areas that are quite out of favor, meaning Brookfield will own highly discounted office, sometimes on a tactical basis, or they've moved into retail in a bigger way than Blackstone has historically. Blackstone has pivoted, or that's what we've witnessed over the last 5 to 10 years, towards a bit more of a secular focused, growth-oriented approach to real estate, which is more analogous to the Barron approach of identifying best-in-class, high quality. If we own the best real estate, we're going to grow a bit faster than the peer group. And ours is a bit more similar to Blackstone. But they're both terrific, terrific companies.
What's the growth in the healthcare real estate sector? What kind of real estate does that encompass?
So the area of healthcare that we're focused on are companies that are prioritizing senior housing real estate. So think about independent living, assisted living, and other forms of care. The prospects for senior housing real estate are about as exciting as we've seen in more than 10 years. And the reason is that it's benefiting from a combination of a cyclical upturn and a secular upturn. The cyclical upturn, think about it, during the early days of the pandemic, very few people were going to senior housing facilities.
Right,
they were avoiding it for obvious reasons. And so occupancy is depressed, and now there's a big opportunity for occupancies to increase now that there are vaccinations, rents to improve as well. That's the cyclical upside. And then the secular upside, of course, is that people are living longer, and the senior portion of the population is the fastest growing portion of the population. So it's a very exciting area where a company such as Welltower, we believe, can grow its cash flow well into the double-digit range over the next several years.
Looking at the commercial real estate, again, this broadly diversified commercial real estate portfolio that you have in the Barron Real Estate Fund, what role does that play in your portfolio, the commercial real estate segment?
What role does it play broadly in the Barron Real Estate portfolio?
Yeah, in your portfolio, right.
So real estate long-term offers some inflation protection, also offers some diversification benefits relative to equities and bonds. And now that real estate has lagged and repriced for a higher cost of capital, we think the setup for long-term returns is attractive. Our strategy has an abundance of commercial real estate in the portfolio. Right. If we were to pull it together and segregate commercial versus residential, the commercial piece is about 2/3 of the portfolio, and the other third is residential real estate.
That's very interesting. And of course, in part 2 of our interview with you, which will run next week, we are going to discuss the state of the residential real estate market and the opportunities there. So, Jeff, the one investment for a long-term diversified portfolio, considering that we've been talking about commercial real estate, what would you have us all own some of in a diversified portfolio?
Well, one investment theme that we haven't talked about extensively is the intersection of technology and real estate. And there is a company called CoStar, which is leading the digital revolution around real estate. And we think the long-term prospects for CoStar are very exciting. Why is that the case? I'll give you 5 reasons. Number one, this company over the last 20 years or so has invested about $5 billion creating a proprietary commercial real estate database. Think of it as perhaps the Bloomberg of commercial real estate, where they have information on millions and millions and millions of commercial real estate properties that are helpful to buyers, sellers, landlords, banks, that are seeking to gather information on commercial real estate. This is a $2.5 billion revenue business that generates about $1 billion of cash flow. It's a terrific business because it's a monopoly, and it's a subscription-based business where there's high retention rate, grows top line about 10 to 12% per year, and cash flow much faster than that. And so we see an opportunity for this company to double its cash flow over the next 5 to 7 years. That's piece one. Piece two is they're moving now to create the leading digital residential marketplace in the world. They're investing $1 billion to create Homes.com. I don't know if you saw the commercials over the Super Bowl, and it's running all over TV right now, but they are going after the residential side of real estate as well right now. Let me just frame the opportunity here. In a given year, there typically are about, let's call it 5 million home sales in the country, okay? And if the average home price is about $400,000, you do the math on that, there's about $2 trillion of transaction activity every year. A real estate broker, okay, let's say the commission is 5%. 5% of 2 trillion is about a $100 billion opportunity. CoStar thinks over time perhaps they could capture 5 to 10% of that market. It's an incremental 5 to 10 billion of revenues at higher margins. Maybe this could be another multi-billion dollars of cash flow that will come on. Number 3, they will eventually go international. The opportunity in the rest of the world is at least as large in the US. Number 4, they're sitting on $5 billion of cash to deploy towards accretive acquisitions. And you wrap it up with an absolutely phenomenal management team led by CEO Andy Florance, who is one of the most brilliant executives we've ever come across. He's smart, he's strategic, his interests are aligned with us. We think this company can compound at about 20% per year over the next several years. We're very optimistic about the prospects for CoStar.
Wow. And, until I had looked at your portfolio and seen the name CoStar, I had not really recognized how pervasive their data gathering is. And I've noticed CoStar being used by the Wall Street Journal as a source and a number of other publications.
I wouldn't suggest that the shares are very cheap per se, but what the market is not factoring in is this opportunity on the residential side, the opportunity globally, the opportunity to deploy $5 billion of cash flow accretively. So when we put all this together, the market is not giving any credit for that. That's what's the multi-year opportunity, and again gives us optimism that this is a company that one will be able to compound returns annually at about 20% or so a year on a multi-year basis. So we're very optimistic about the prospect. And again, you won't find CoStar in a more traditional REIT fund, but you will find it in the Barron Real Estate Related Fund because we embrace a more open-minded philosophy to investing in real estate.
Right, and your performance certainly reflects that. All right, Jeff Kolich, thank you so much for joining us on Wealth Track to talk about commercial real estate. I look forward to discussing the residential real estate market with you in the very near future. Thanks, Jeff.
Thank you very much.
At the close of every Wealth Track, we try to give you one suggestion to help you build and protect your wealth over the long term. This week's action point is consider a real estate fund. Real estate is the world's largest asset class by far, valued at nearly $400 trillion. In the U.S., the residential market has an estimated worth of $52 trillion, and commercial real estate weighs in at around $21 trillion. As Jeff Kolich just explained, there are opportunities in both. The vast majority of real estate funds are REITs, real estate investment trusts, that invest in portfolios of actual properties that are required by law to distribute at least 90% of the income from those properties to shareholders, who then pay the taxes on the income. REITs are valued for their income, long-term capital appreciation, and low correlation to the stock market. Among the real estate funds that Morningstar recommends are the actively managed Cohen & Steers Realty Shares, which carries a 5-star bronze analyst rating. This is a REIT and is managed by Cohen & Steers, one of the oldest and largest firms in the business. The other is a passive index fund. It's Vanguard Real Estate Index Investor, rated 3-star gold. It is also available as an ETF, the Vanguard Real Estate ETF. Both replicate the REIT-heavy MSCI US Investable Market Real Estate 2550 Index. Morningstar calls the Vanguard offerings among the best U.S. real estate funds available. For the record, Coalich's much more diversified fund has outperformed both Morningstar recommendations since inception and most multi-year periods in between. Adding publicly traded real estate to your portfolio provides exposure to the world's largest asset class, and a dynamic one at that. Well, next week in part 2 of our real estate series with Jeff Kolich, our focus is on the investment opportunities in the giant residential real estate market. In this week's extra feature, the story of where Kolich picked up his passion for real estate. Don't hesitate to follow us on Facebook, X, and our YouTube channel. Thank you for watching. Have a fantastic weekend and make the week ahead a healthy, profitable, and productive one.